Hello, I'm Brent Wilsey, and with me is Chase Wilsey. We're from Wilsey Asset Management. And I'm sure you heard the saying, oh, the rich pay no income tax, the middle class pay it all. Well, that's really not true. Based on a research study done by a research group named Tax Policy Center, they're nonpartisan, and they put together what people really pay. 45% pay no federal income tax. That's Americans. Look at the numbers, 77.5 million pay no income tax, and of those 77.5 million, half have no income. Could be like Social Security, could be under the table cash and so forth. The other half is from tax breaks. Now before you jump to conclusions thinking, we know the rich aren't paying it, that's not the case, is it?
Yeah, I mean, these numbers are pretty astonishing when you take a step back, and look at them. You know, the top 20% pay 87% of the federal tax that is collected.
That's huge.
Yeah, and taking a deeper look at the numbers, middle income on average pay $1,743, and then top 20% on average pay over $50,000 a year in income taxes.
And what that is, that people get so confused, they heard about Warren Buffett, oh, his tax bracket's lower than his secretary. Well, that's the percentage tax bracket. Dollar-wise, a whole different story. The rich do pay, well, almost 90% of what the federal government is charging us.
Yeah.
So the rich do pay their taxes. People concerned, it's the presidential year, and oh my gosh, are the Super Tuesdays on, and oh, I better not invest until this is over, until I know what's going on. That's a bad mistake to make. Don't get off track when it comes to investing. You're looking down the road 2-3 years. And look at this number here, since 1928, if you invest in the S&P 500 during this last year of the presidential term, average return, 7%. And that's not all that's going on this year, is it?
Yeah, well, small companies tend to do better on average in election years, which I was pretty surprised by. And also with the Republican House, which what we have right now, on average is up 19.7% in election year.
Yeah, so don't get excited like, oh, we're going to do 20% this year. That's not the case. But understand, do not sit on the sidelines and wait. I heard a commentator today on Bloomberg, and she goes, well, investors, you know, they can't wait 6 to 9 months. I'm thinking, what is wrong with this woman? I mean, you should be investing not for 6 to 9 months, 2, 3, 4 years. You should be an investor, not a gambler or trader.
Yeah, and I don't care who the president's going to be, you know, Hillary Clinton, Donald Trump. Either way, companies are going to be all right and prosper in the long run.
Yep, so focus on the companies, focus on the investment. Don't worry about all the noise outside. I'm talking about the election. That's, well, it's on the TV every day, every hour, every day, it seems like. Every week we talk about, actually every day, we talk about a company, sometimes a buy, sometimes a sell. Well, I got excited today about DreamWorks, symbol DWA. And I like this company because I'm sure you remember Shrek and Madagascar and Ants, which I thought was a very funny movie. Well, the current price right now is on $25 a share. Their 52-week low is 17 with a high of $29 a share, but that's not the whole story, is it?
Yeah, well, our earnings per share were up 82%, so that looks good. Debt to equity here, 31% versus the industry average at 119%. So another appealing number. Always important to take a look at the balance sheet before investing into a company. You know, I was a little sad when I took a look at this last number here just because I was very excited about DreamWorks, you know, brought back some of those good childhood memories. But going out to December 2017, estimated earnings per share are $1.05. As good as a forward PE of 24, well above 16.5 for the 40-year average, and even more above the 10 to 12 where we like to buy companies.
And you just have to say, doggone it, I want to buy that company, but it's too expensive right now, so be patient there. And I do want to point out that they had $500 million of debt last year. They did pay off $150 million in debt, so they're doing all the right things. But be patient, wait for it to come down, or earnings will go up a little bit more for you. I'm very excited because March 19th, we have a workshop coming up. It's a National University in Rancho Bernardo. We're going to teach you how to be a smarter investor.
Yeah, at the workshop, we will be analyzing a company that could be a potential buy in our portfolio, and that company is locally based Qualcomm. We'll be reviewing stock fundamental analysis and why it's successful. We'll be explaining when to buy and sell a stock, and also we'll be going over the 5 common mistakes that the average investor makes.
That one's huge. So if you want to sign up, go to smartinvesting2000.com or give us a call at 858-546-4306. And I have to say, I've had thousands and thousands of people come to my workshops, and not one ever complained they didn't learn anything. We promise you, you will learn something that you never knew before. So hope to see you there on March 19th.